Today, I will be focusing on what the negative voices, often called bears, are currently saying about Palantir. I want to be very clear that just because I am sharing these viewpoints does not mean I personally agree with them. My goal is simply to help you stay informed about all perspectives so you can make choices that fit your own investing goals. So with that in mind, let's get right into it. There is a growing opinion among some market watchers that now might actually be the right time to sell Palantir stock. In just the first 6 months of this year, Palantir's stock price has soared by approximately 90%. The underlying business fundamentals, according to them, do not justify the high price tag the stock currently carries. Because of this, they are warning that investors should think carefully about whether it makes sense to continue holding onto their shares at this time. To help you understand this point better, it is useful to look at how other companies have performed in the past when they reached similar sky-high valuations. I want to give you a heads up right now though, because every example shows that things did not turn out well for investors in those situations. Let's take a moment to look at what Palantir actually does as a business. The company develops artificial intelligence software that helps users make more informed decisions by using real-time data. This technology was originally created for government purposes, but over time it has expanded into the commercial market. Even though the majority of Palantir's revenue still comes from government contracts, its commercial side has grown to a point where it is now bringing in a significant share of the company's total revenue. Many investors have identified Palantir as a key company in the artificial intelligence space. They believe that as demand for artificial intelligence software continues to rise, Palantir is in a strong position to benefit. In this sense, the investment thesis in favor of Palantir has actually been correct so far, as the company has delivered solid growth numbers. For example, in Q1, Palantir reported that its revenue increased by 39% compared to the same period last year, reaching $884 million. One of the brightest spots in the company's financial results came from its commercial revenue in the United States, which climbed by 71% year over year to reach $255 million. Looking ahead to Q2, Palantir's management team has stated that they expect revenue to come in around $936 million, which would represent a 38% increase in revenue compared to the previous year. Although this is slightly lower than the growth rate seen in Q1, this is not necessarily something that should cause alarm. In fact, Palantir has a history of beating its own conservative forecasts. So if the growth rate ends up somewhere in the low 40% range, most seasoned investors would not be too surprised. However, despite this encouraging revenue growth, there is a major issue that critics keep pointing out. While Palantir's stock price has skyrocketed by 90% in the last 6 months, the company's revenue has only grown by 39% year over year. This creates a mismatch that is concerning to many because over the long term, stock prices tend to move in line with the growth of the underlying business. While short-term excitement or hype can temporarily distort this relationship, history shows that eventually the numbers need to align. Adding to this concern is the fact that Palantir stock also experienced a significant rise in the year 2024. This means the stock price has now moved so far ahead of the company's actual business results that some believe it is only a matter of time before a correction takes place. As a result of this sharp rise, Palantir stock is now trading at 115 times sales. To put this in perspective, very few stocks in the history of the market have ever traded at this kind of extreme valuation. None of the other companies that have reached such a high multiple while growing at a similar pace have delivered good long-term outcomes for investors. Let's look at some real-world examples to help make this point clearer. One company that faced a similar situation was Zoom Communications. Zoom became incredibly popular during the COVID-19 pandemic because its video conferencing service allowed people and businesses to stay connected when in-person meetings were impossible. At its peak, Zoom traded at 125 times sales. However, at that time, Zoom was growing its revenue by an astonishing 350% year over year. Even with that tremendous growth, Zoom's stock price is currently down by 86% from its all-time highs. Another example is Snowflake, a company known for its data cloud services. Snowflake experienced very fast growth over multiple years, often maintaining revenue growth rates above 50%, which is much higher than Palantir's current growth rate. However, if you had purchased Snowflake shares during its initial public offering in the year 2020 or during late 2022, when the stock last traded for more than 100 times sales, you would still be down about 45% today. The overall takeaway here is that expecting any company to sustain a valuation of 100 times sales or more is extremely unrealistic. Sooner or later, stock prices tend to come back down to earth. For Palantir, many observers believe that such a correction is not only possible, but likely. This is because the company's current growth rate simply does not support such an inflated valuation. At this point, they argue, the stock price is being driven more by excitement and high expectations than by actual financial performance. Some experts are going so far as to predict that Palantir stock will definitely be trading at a lower price in the next few years. They point out that no company that has ever traded at 100 times sales has been able to produce solid, lasting results for shareholders. Therefore, they advise that investors should consider stepping away from Palantir before it is too late. They believe it is only a matter of time before reality catches up with the stock price, and they argue that it is wiser to avoid the potential pain of a major correction. Essentially, some market critics are warning that Palantir stock, which has surged by around 90% in the first half of 2025, may be overvalued because the company's business growth does not fully support the steep rise in its share price. While Palantir has shown strong performance with revenue growing by 39% year over year in Q1 and United States commercial revenue climbing 71%, its stock is now trading at 115 times sales, a level that history suggests is unsustainable. Examples from companies like Zoom Communications and Snowflake, which once traded at extremely high sales multiples but later saw significant stock price declines, highlight the risks of investing in stocks valued far above their actual growth rates. Critics believe that although Palantir is well positioned in the artificial intelligence space, its current valuation is driven more by hype than by its financial fundamentals, and they caution investors to consider stepping away before a likely correction occurs. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.